Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the news that moves the markets. Before we get started here, if you are excited about your precious metals hedge and looking to add ounces, we have 4 perfect solutions to take the guesswork out of it for you, including the Sleeping Giant Silver that gives you the double play in ratio and premium. You can follow the link in the show notes below to download our free report on the precious metals market today and the 4 package offers that we have. What a difference a week makes, but before we get into the market changes since our show last week, we do want to jump into a couple listener questions. So Eric, what do you got for us?
Yeah, this week's listener question comes from Javier Bitcoin. He says, Bitcoin is real money for this century. Wait and see. Gold and silver are money tools from last century. They are obsolete. Still better than fiat.
Wouldn't you say 2 centuries ago, not last century? The dollar was the monetary tool from last century, and look how well that worked out.
I would say 50 centuries. Here's the deal, Javier. We appreciate the feedback, and we don't disagree that cryptocurrencies are a modern century form of currency and exchange, and that technology is here to stay. It's just that many of the individual cryptocurrencies are not here to stay. So if you can pick the exact one that's going to stick around, or ones, then go for it. The issue is that gold and silver are here to stay. Now, it's a different part of the portfolio as well, so please don't confuse a speculative investment play in cryptocurrencies with your tangible physical commodity play as your insurance or the base of your portfolio. And what I'd like to put up here is just to lend a little clarity to the portfolio approach we recommend, just this 3-piece pie, and this will help you understand a little bit about how we say diversify. Cryptos are in a completely different category.
All right, our second question this week comes from Yellow John, who's a new listener to the show. Yellow John points out that he researched the gold to silver ratio in multiple countries, including Argentina, Venezuela, and he found that the gold silver ratio is 89-1 in every country right now. And he's wanting to know, how can this be? And wants an explanation. Well, a great explanation came right below that from Gregor, another listener, and he said, it is the exact same because gold and silver prices are fixed in dollars. The ratio is built by that. Other prices worldwide are just made from the exchange rate of the local currency to the underlying dollar. Miles,
Sure.
can you touch on that?
Yeah, Gregor, that is a perfect explanation. I would definitely second. I mean, we're talking about the relative values of currencies, and then obviously the prices of things kind of branch out from there. So if you see a 20 or 30% relative pricing in the currency, you'd expect to see that same type of pricing difference in the goods and commodities between those different countries, unless we get into things that we may bring up later today when you're talking about trade tariffs and some of the different taxes that can impact that on either side.
Good point. I think the takeaway really is, regardless of what country you live in, buy silver.
Well, fellas, moving into the meat of the show, I started the opener with the line, what a difference a week makes, and kind of glad I wasn't here last week, simply so walking in this week, eating crow, but eating crow the best way possible. I never saw my 1240 number. What happened?
Well, you haven't yet, but you're right. What a difference a week makes. We were talking on the show last week about how flat gold had been. Not anymore. Tell us, a little bit about why you think this has happened and what are the numbers?
Sure. Well, I mean, we're talking in gold specifically, and we'll certainly get to the white metals too. But gold specifically up 5% this month, or at a high point. I said somewhere in the 1240s, and just today on Wednesday, we actually got into the 1340s. So apologies, I was $100 off. Although I will argue, a couple weeks ago, we always, when we're looking at entry points, you want to pick a high point and a low point. We did say if we're looking at numbers above 1310, you want to start getting in at that point.
That's right.
Now, that was seconded last week by Pamela and Marianne Aiden, who followed the ABCD wave, Elliott wave theory. When we saw gold pushing up above 1310, the Aiden sisters put out a missive stating we could be seeing the start of the C wave, the most aggressive rise in any of these market cycles. So as we retested that old declining multi-year trend line up in the 1340s, arguably starting to look really bullish again, and a lot earlier than I think any of us thought it would.
You may still see that number, Miles. I mean, obviously we're coming into some certain headwinds here in the metals markets. One is just they're not going to want gold to get a lot of attention, okay? 2, they're going to do everything they can to reverse the equities markets decline that we've seen here recently as well. and we'll talk about that later in the show. 3, we're still coming up on that seasonal weakness that we've got, precious metals wise.
Or had,
and we may have made it through. And we did mention that if we broke above 1310, that is a buy signal. Where does it take us here? Let's say, on your chart, we have exceeded that. Where is the new floor? Where's the new support level? And now where's the new resistance level to the upside?
Well, the resistance level stays at that top end trend line, which we're not above yet. So, and you can see this is the 6th time now in the last number of years that we've come into this, and every single time we get to it, it's been less times since the previous. You used to have a year or two in between. Now it seems it's every 6 months. We're trying it again. So the defense is still holding, but the offense is trying to push the ball through. And I think the Bears will run out of strength and will run out of short money eventually. So to answer your question, if we get above that, obviously the old high of 1375, anything above 1375, we're looking in breakout territory at that point, and a pretty substantial jump up to set a new trading level up in the 14 or 1500s.
And now hopping into the white metals, silver had a good week this week, met resistance at $15. Actually, this morning in the Asian markets, it broke through $15, about $15.05, and now as we record on Wednesday, we're back into the $14.88 range. The gold-silver ratio is still unchanged, which tells us that silver's still lagging. We're still at over an 89-to-1 gold-silver ratio. But, Miles, what do you see for silver from here?
That $15 ceiling, obviously there's some double zero psychological levels there we'd have to go above. So I can't call for a trend reversal until you actually see a trend reversal. So the assumption is still down in silver until you see us break above some of these levels, then a retest that fails to go lower, and then putting in a higher high. So you've got to see these patterns start to build. So let's pretend that's happening. I'd say a push down to about 1460, and then we'd have to break above 15 to argue any type of trend reversal here. So I stay bearish until I can prove it's bullish. Gold looks like it's starting to prove bullish, especially if we get up into the 1350s, 1360s. Silver would have to follow suit with a similar type of movement.
That's a great point, Miles. Gold's actually showing that it does better in times of deflation. And, we've also seen some of that this week. I know you'll get into the currencies, but it's the true money metal. It's the more stable of the two. And so that ratio will widen with similar activity. Not a whole lot of action, though, in platinum and palladium this week. I mean, all said and done, yes, platinum's up 2% this week. That sounds great. Palladium's down 1%. So we're back above 800 in platinum. We're currently 1339 in palladium, but we did see a lot of activity shooting up as high as 825 in platinum 2 days ago.
Sure, and platinum came into that 382 fib, that first ceiling test. Again, not breaking through. It is good to see it recovering some of the ground it's lost. And palladium, really, I've got nothing to say there. I mean, it sits within its trading range after that big collapse we had in the palladium price earlier this year. It's not surprising to see it just sort of try to find some legs one direction or the other.
Miles, as Tori mentioned, it has been a busy week for the metals in a positive way, but what's driving this? Is it fear of a global economic slowdown? Is it word from the Fed that they're going to start cutting rates? What is driving this movement in the metals right now?
Well, I think a little bit of the above, right? I mean, we've got the trade talks between us and China. We have a economic slowdown, not just here domestically and in oil pricing, in manufacturing and transportation. Europe is facing some financial and economic slowdown issues. You guys did a great job last week bringing up Deutsche Bank and kind of talking through how that is affecting the European markets. And we're, like I said a second ago, sitting on the heels of this big trade negotiation, which could see some increased tariffs on goods coming into the United States. And that's expensive. That starts costing people real money out of pocket. So we're talking about a country that pretty much lives on manufactured goods from China, now having to pay more for manufactured goods from China. So I think the dollar, because we're seeing this economic slowdown globally, the United States is still the world's biggest consumer of everything. We're the bottomless pit. But if some of these manufacturing countries are selling us goods or starting to see prices increase, expecting a slowdown of U.S. buying because of that, it's not surprising to see institutional money going into U.S. dollars, which is slowly and surely pushing that price of the U.S. dollar up, not just on the index, but even more than on the index, which is up a few percent, but against other currencies like the euro or the yuan.
Yeah, Miles, and as you can see on this chart, the dollar is actually up 12% against the euro since last January.
That's given us a lot of headwinds in the gold price, right? When you see the dollar that strong on the world scene, of course you should expect the gold price to kind of limp along.
Yeah, and Tori, you and I saw an article this week from JP Morgan that they're now calling for 2 rate cuts in 2019. When we started this year, we were expecting to have 2 rate hikes. Now we've shifted and we're looking at 2 rate cuts. And the reaction in the equities market is that this is a good thing. This breathes a little life in. We see the rally yesterday, a little rally today, but it seems to me that this shouldn't be cause for celebration.
No, I totally agree. It's desperate measures, is
well,
it not?
Of course, of course it's a good thing for the equities markets. They failed to breach the old highs. They're off 7% over the last month or so.
It's not cause for celebration. It might be cause for celebration if you're looking for a stay of execution, right? But it's not a cause of celebration if you're looking for good, viable numbers to support a healthy economy.
Or actual value.
Right. Okay.
Or
as
a
long as you're
PE ratio worth investing in.
Yeah. Or earnings per share or anything like that. It's not something that you want to be chasing because, again, this is like last-ditch effort kind of stuff to try to inject more capital. The way they're injecting more capital is through borrowing, lending, right? So because it's a credit-driven economy right now, you're going to see certainly maybe 2 rate cuts. Yay. The bond market's already priced it in, right? It's already priced that the interest rate in the bond market that matters is below 2% already. And so I don't think that it's going to have the effect that it would otherwise have. We talked about Deutsche Bank last week. That stock has steadily continued to decline in share value. And now it's, seen a low of 662. We didn't hit that 640 critical number. Probably won't happen for another month if it does. But that being said, it bounced above 7 and now it's back below 7 again. And that's the one to watch. But here's my concern. Okay, 2 rate cuts. What does the European Central Bank do? When that hits, let's say we have a 2019 Bear Stearns Lehman Brothers event in Deutsche Bank or Santander. All right. What do? Their interest rates are already at 0. At least we have some room. There is not that arrow in that quiver anymore. What do they do in terms of quantitative easing? They've already been doing that. They never paused like the Fed did and started really tightening. And at least from the domestic standpoint, we've seen both of those taken, and we can have a little bit of room to try to counter a true slowdown economically.
Sure. I mean, you reach a point where you're barely keeping your nose above water, but you've got no more room. They really have no more room minus negative rates. So now we bring back the old Cyprus question of if they come back with negative interest rates, does this become a bail-in situation for Europe as a whole?
Bail-in, absolutely. Massive quantitative easing, right? Much like what the U.S. had to do with AIG back in 2008 and 9.
And when we go back domestically to the Fed cutting rates, it kind of puts gold in this perfect scenario, but I want your opinion on this, Miles. If they cut rates, it's going to weaken the dollar, which should affect
I mean,
the price
we're
of
talking
gold, right?
about actual logic here. So that's
Right.
that's a logical question. The
good old
markets aren't
days.
logical.
Right, but if they raise, if they leave them unchanged or raise it, that puts downward pressure on the equities again. So is gold in this perfect scenario with whatever the Fed does, gold wins from it?
Well, here's what's scary is, as Tori mentioned, I mean, they're already speculating on 2 rate cuts this year. So that news is already out there. At least the expectation is gold's up almost $100.
No, it's a great point, and it's the other thing that hasn't slowed down, spending. We're up $19 billion this week on the national debt to 22.351, which is laughable, and that's all despite and because of, as Bloomberg put it, quote, global synchronized slowdown, unquote. So let that give you chills, and let it just support the fact that you've taken the right steps by hedging your portfolio in physical metals right now. And to that point, I mean, global synchronized slowdown, oil's telling us exactly that. Miles, you ran right by it, but oil's down 12% this week from last week's show. I mean, we're below $52 a barrel now. And the last time that we saw, the last 2 times actually, where you had a week when gold and silver stocks rallied at least 5% and oil declined by 8.7% or more, was back before the tech bust and then back right before the global financial crisis of 2008. So is that a scary thought? Yeah, that's a Market Watch article that everybody should look at.
So that's going to do it this week for Golden Rule Radio. We thank you for stopping by. If you like what you heard, click the subscribe button, ring the bell, head on over to Twitter at ICA Gold, Facebook, McIlvaney Financial, or our website, McIlvaney.com. As always, you can call us at 1-800-525-9556.
Just as a reminder, too, you can click the link in the description below. It'll take you right to our most recent recommendations that represent the best value in the precious metals markets.
Thanks for listening. Have a great week.